Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Carol Massar along with Tim Stenovec live at Bloomberg Invest in downtown Manhattan. Well, the NASDAQ 100, you know some of the numbers. It's up nearly 40% from the late October low. NVIDIA's up more than 150% this year, 150% this year. Super microcomputers up 200%. Meta's up more than 40%. Netflix is up 40%. I mean, we could go on and on and on.
Yeah, Alphabet 30% so far this year. Even better, let's get to someone who is constantly tracking the global equity market and patterns, who earlier at Bloomberg Invest talked about the tech bubble 2.0 or not. With us is Bloomberg Intelligence Global Head of Portfolio Strategy and Chief Equity Strategist, Gina Adams. She's here on site at Bloomberg Invest. So, a bubble, yay or nay?
Well, first of all, did you ask the audience if they thought?
No.
Okay, good. So, okay.
I had no time, only to share all of my immense amount of slides.
And the research shows that.
Yeah, so look, a lot of the research we did really just compared the current environment to 1999, which I think most people think of as the classic bubble. But we do look at three really key differences between today's market environment and bubbles of the past. The first is sentiment and price trend. What we've seen in the market over the last 5 years is an 85% ascension in prices. If you could look at big bubbles, like the late 1990s, the late 1920s, you had 400% gains in some cases, at least 200%.
So this looks small compared.
So this is just a tiny gain over the last 5 years because we've had those major corrections in the process. The second thing to think about is really fundamentals. When you look at valuations, valuation spreads are nowhere near peak levels of even 2021, which you could claim was a market bubble, or 2000. So valuation spreads are nowhere near those levels. Valuation spreads, when we look at the most expensive stocks and compare those to the least expensive stocks, I do believe are the best representative of what sort of market sentiment or froth exists, because the earnings environment has really supported rotation into those more expensive stocks. For the most part, the priciest stocks in the index are actually the stocks that have earnings growth, because there just hasn't been a lot of earnings growth elsewhere.
You're just back from traveling.
Yes.
And I'm sure you've been talking about this.
Yes.
Are there believers or are people more skeptical about the run-up?
I think there are a lot of skeptics. There are a lot of people that are just very worried.
Yeah.
The concern really emanates from concentration risk, though, which is the third point of how this environment is different, because we're incredibly sensitive today to what goes on in tech. I mean, before the advent of even the AI acceleration, tech was 30% of the market cap of the S&P 500. Back in the peak of the market bubble in 99, 2000, we didn't get that. It was just, there just wasn't this kind of influence. AI in particular has an extraordinary amount of influence, and it's a global phenomenon. And that's what what sparks a lot of fear is we are very dependent upon a continued solid environment for tech stocks. Can we trust tech stocks? Can we trust these companies are going to be able to put up this kind of earnings growth that is anticipated by the consensus? And can you make money in an environment where such a few amount of stocks is actually carrying the index growth? And so there's a frustration.
You gave us
it.
questions that we should probably ask. Can we trust? Can you make money?
Yeah, you can, but it's very narrow.
Okay.
Right? And it's very difficult to beat the index. If you think about across markets, most major markets have stronger index level returns down in the United States over this quarter, yet the index is up. It's the same in many markets around the world. So it's really difficult if you're an active manager to beat the index without leaning really heavily into AI and tech right now, and that makes folks very
Which just kind of feeds the momentum to some extent.
It does. I think that there has been this very big earnings case for tech stocks, though, and AI stocks at large, and that's going to change in the second half of this year. And this is what we spend a lot of our time talking about is, can we get that increment of change in fundamentals that can support rotation into other parts of the market? We've been waiting and waiting and waiting for it. We've also been contending with this rolling recession throughout various industries for the last 2 years. It's just really difficult for investors who are accustomed to kind of the cycle, the economic cycle driving everything, and this has been a very different cycle.
Gina, how are you and the team thinking about productivity growth as a result of AI being implemented at companies that are not tech companies?
Yeah, we think about it. It's not in any numbers.
Yet?
No. It's not in any numbers. It's not even mentioned by companies. So the way that we work on it...
But how do you think about that? That it's like, okay, we're talking about all the AI that's happening in terms of the training of these LLMs, all the chips that NVIDIA is selling, all the chips that folks are buying. But what's the ultimate
It's all
end game here?
Inside tech and communications so far. It's like this one little unit inside, very big unit actually, inside the broader market. So we're seeing implementation, we're seeing buying, we're seeing all of the AI impact occur inside tech and communications, or TMT industries, with some consumer discretionary, because Amazon's a consumer discretionary company, right? So,
so that's why.
Yeah. So it's very centered right now. Now, will it spread? You know, we're tracking a number of things. We look at transcripts from companies every quarter, and we track their mentions of AI and their degree of optimism around AI. We look at the Census Bureau does a lovely survey of all industries and their planned implementation and impacts from AI. So we look at that. That's every other week. There are sectors that are starting to mention it as a potential, having some potential, and that's largely financials and real estate so far. So we're watching financials and real estate. Utilities are suspiciously not mentioning AI. So that's the other side of this story, is for some reason there's this market frenzy around utilities being a huge beneficiary. Utilities companies themselves are saying, oh, stop.
That's interesting. That's interesting.
They're not even mentioning it yet, and they're not talking about it really benefiting them or spending on it. So
that's fascinating, because at Milken, that was a big play. It wasn't NVIDIA and the chips necessarily. That was interesting too. But it was, and the energy needed for data centers. You know, one of the things that was interesting yesterday is Pool came out. Pool Corporation. They do pools.
Yeah.
And they were talking about, yes, they were still doing maintenance sales and stuff, but people weren't spending so much. It was another consumer discretionary, or sign of a consumer discretionary slowdown.
Yeah.
How are you thinking about that space? And maybe what it tells us about those companies, but the economy more broadly.
Sure. We talked about this a lot coming into 2024, because we are anticipating seeing a consumer slowdown in 2024, and the consumer sectors do look somewhat vulnerable to that slowdown, consumer discretionary and consumer staples. Now, what's really interesting about this is this could have very small impacts on the S&P 500 at large, and this goes to the concentration of market cap in the S&P 500, which is less and less about consumers. Like, I've been in this business long enough to remember when I really cared about what was happening for the consumer, because consumer retail was a big portion of the S&P 500.
So not so much anymore.
It is tiny now. Think about name a retailer in the S&P 500 that's not Target or Walmart.
Yeah, it's
you can't.
Home Depot.
Because
or Amazon.
Those are home improvement companies. But
Amazon?
Yeah, Amazon, which is more a tech company than a consumer retailer, right?
But
it's very difficult to get that read through.
But what about a company like Meta Platforms that support, or Alphabet that is supported through advertising right now?
Yes.
If those companies that are paying to advertise are not seeing their customers show up, then they're going to pull back on advertising.
Well, let's think about the companies that are paying for advertising. Are they car companies? Are they housing companies? What kind of companies pay for advertising now? And that's where I think we need to do the mental gymnastics, because we make the presumption that we live in this environment that existed 10 or 15 years ago. But what if Netflix is the primary buyer of ads? What if Disney is the primary buyer of ads? And those expenditures are no longer discretionary expenditures for the consumer. They're staples, right? So I think you have to do the work to think through the impacts of all of these economic indicators that, and I completely agree with you. I spent my life prior to becoming a strategist as a consumer economist. The consumer was my life, my lifeblood. I thought that was the end all be all. And then I have spent the last 15 years as an equity strategist understanding that my consumer forecast is only going to peripherally impact my equity market forecast.
So just got about 30 seconds. The lifeblood of the equity market is what then now?
Tech.
That's it.
I mean, 40% of the market cap of the index is tech plus Meta and Google and Amazon and Tesla.
And justifiably.
And that is what drives the U.S. equity market from large cap perspective. Now, small caps is a very different animal, and I think we should be watching this pretty carefully, because small caps is more about healthcare and financials, a little bit of energy, industrials. Small caps have been basically flatlining for 3 years running.
We keep talking about it.
And maybe more reflective of what's going on in the broader economy than the large cap index.
Such good stuff. Thank you so much. So
Thank
appreciate
you.
it. We know you've been traveling a lot, so good to get some time. Bloomberg Intelligence Global Head of Portfolio Strategy and Chief Equity Strategist Gina Martin-Adams here at Bloomberg Invest.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You are listening and watching Bloomberg Businessweek. We're live at Bloomberg Invest in downtown Manhattan. And what's interesting about Bloomberg Invest is that you end up getting to hear from people from all of the investment world, really just different types of investing, different types of investing platforms. And that really brings us to our next guest. And she happens to be one of Bloomberg Businessweek's ones to watch. These are the investors, money managers, executives, and strategists who are shaping the future of finance.
We're talking about Alyse Killeen, who founded the venture capital firm Stillmark 5 years ago, offering up both institutional venture capital knowledge and expertise in Bitcoin. Alyse joins us for more on her journey and today's landscape here at Bloomberg Invest. Alyse, how are you?
I'm well. Thank you for having me.
Well, thanks so much for joining us. Before we get into what you guys are doing, I just got to get your comments on what we heard from SEC Chair Gary Gensler. I don't know if you were in there listening.
Of course.
Okay, because he spoke a little earlier, and he declined to give a timeline for launching Spot Ether ETF, but did say that it's going smoothly, and he said there's also significant non-compliance when it comes to crypto. How do you take his comments?
So Gensler has been very consistent in the guidance that he's provided to the crypto and Bitcoin ecosystems. And I thought that his comments today were consistent with comments of the past. We know that many operators in the crypto sphere are operating in a non-compliant way. Stillmark, of course, is focused on the Bitcoin landscape. So that falls outside of our mandate, though we're tracking it nonetheless. On the ETF side, of course, while we expect, and it seems Gary Gensler also expects for an Ethereum spot ETF to be live this year, what we've seen in other markets, for example, in Hong Kong, where the Bitcoin and Ethereum ETH ETF, spot ETFs launched on the same day, we saw much more modest activity around the spot ETH ETF relative to Bitcoin. In Hong Kong, we saw about 14% of the activity and assets go to Ethereum, and the rest of that balance go to Bitcoin.
You know, if you could talk to Chair Gensler right now, what would you ask him, or what would you want to discuss with him?
I think where we're curious how he will move forward is around issues related to money transmission and how that relates to Bitcoin's payment network, the Lightning Network.
Right.
We are interested and hopeful that those at the SEC will take a researched and studied approach to how they will designate money transmitters in the field so that they are precise and discrete in those definitions rather than taking a broad swipe at defining actors as money transmitters where they wouldn't properly otherwise be.
You're making investments in that area.
Of course, yes.
Is that where, when you look at the VC landscape or what you guys are involved in, is that where a lot of the money's going and the opportunistic aspect of the crypto world, or Bitcoin specifically?
So in Bitcoin, about half of our current investments is in the payment space.
Right.
We've invested heavily in Lightning Network infrastructure. So both at the core protocol level, in companies that are developing sort of the AWS model to the payments network, and then in data companies that provide compliance, so KYC, AML services for payments on Lightning, as well as routing across this payment channel network. So while that's an opportunity, there's a breadth of opportunities in the Bitcoin private market space. We invest in payments, of course, but we've also invested in opportunities around Bitcoin as an asset and have been really excited to see that ecosystem so quickly mature, including upon the tailwinds of the robustness of activity for the Bitcoin ETF.
Talk a little bit about the opportunity you see when it comes to the payments network and Lightning specifically here, because I'm curious about the way that people buy Bitcoin right now and sort of how you think about somebody who is quote unquote investing in Bitcoin.
Sure.
Because it seems like still it's looked at as something that will increase in value, and it's the type of thing that will go up in value to a lot of the bulls out there.
Yes.
I don't think it's widely seen yet as something to be used to transact.
Yes, that's changing. So we know that over the 24-month period between 2021 and 2023, ending August 2023, there was a 1,200% growth in Bitcoin's payment network. We know that about 700,000 monthly active users are leveraging the network, and they're using it to make payments that average $12 per transaction. So payments that are most efficient, cost-effective on the Lightning Network versus traditional financial networks. Now, something relevant to today's...
Which is small payments?
Exactly.
Okay.
50% of payments on the Lightning Network are micro payments, in fact. So they're transacting at pennies, quarters, 50 cents.
Mostly we don't know where they are, or do we know where they're happening?
We do know where they're happening. So there's a lot of Lightning Network adoption in emerging markets, as you've begun to say, but we're also seeing payments in gaming, and we will see payments in the AI and LLM space. That's been relevant to today's conversations across money managers. On stage, we've heard a lot about the most important investment opportunities of the next 10 years being the energy transition and LLM and AI infrastructure. In AI and LLM infrastructure, you have to be thinking about the proper payment partner to the new capabilities introduced by this emerging field.
It's such a volatile currency, though, in the sense that, up 4% today, but could be down, 20% from just recent highs as of yesterday. Does that hold it back as something to be used for payments?
Well, so for payments, and especially if we're talking about microtransactions, we're talking about short duration hold. We're really talking about using Bitcoin as an infrastructure rather than as an asset.
So you're not holding it for long, you're converting it to fiat currency very quickly?
That's exactly right. But there's something else happening in Lightning beyond its match to AI and LLM activity, and that is that stable coins are coming to Lightning Network. So soon, as soon as the end of this year, you'll be able not just to transact Bitcoin, but to transact digital dollars on Lightning. And that solves the pain point that you addressed of Bitcoin's volatility, which is relevant to certain populations for sure.
Alyse, just got about a minute left. What does a mature Bitcoin payment world look like, in your view?
A mature Bitcoin payment world looks like reliable payments that can meet Visa's threshold of 99.99% payment reliability. It looks like businesses and enterprise being able to operate payments in a compliant way that's consistent with their existing payment operations. And we're seeing the ecosystem develop to introduce enterprise tools that allow that, including through portfolio companies of ours, such as Amboss Technologies.
When does it happen?
It's happening now.
But in a real wide mass adoption.
I see. So first movers have adopted Lightning for payments.
Right.
Those with the most acute pain points, like those sending cross-border payments, have begun to adopt. And from the learnings of those pilots and early movements, we will see other businesses follow that are seeking more efficient and cheaper payments.
Very cool stuff. Really fascinating. Thank you so much. We totally get why you are one of the ones to watch by Bloomberg Businessweek. Alyse Killeen, thank you so much.
Thank you so much.
Really appreciate it. She's founding partner at Stillmark here at Bloomberg Invest.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Saira Malik is with us. She's Chief Investment Officer at Nuveen. Talk about, man, they've got so much under management, see so much when it comes to investor think, if you will. Saira is Chief Investment Officer, and she also manages more than $100 billion in equity strategies. She joins us here from Bloomberg Invest. Hello, hello.
Hi, good to see you.
It's been that kind of weekday year, the momentum. How do you see the environment right now when there is, it feels like, Saira, like some conflicting signals out there?
Well, first of all, just looking at the markets with the consolidation that we're seeing in stocks like NVIDIA. I mean, markets were up something like 8 out of 9 days just recently. NVIDIA has been this flag bearer stock for the rally we've seen year to date. NVIDIA is just back at early June levels. So this consolidation and the market cap loss for that stock is not, a huge deal. It's just erasing a couple weeks of losses.
In your view.
I think what we need to focus on the second half is three things. That's the economy, election, and earnings. So first, looking at the economy, the news is not all great. Both the consumer and employment markets are starting to show signs of a slowdown. Consumers, we're seeing higher delinquencies. We're seeing discounting at fast food restaurants, lower foot traffic. Consumer is starting to feel the pain. The elections, employment markets. Payrolls have been strong, but you look at unemployment claims, they're almost at cycle highs. Second, elections in the second half. We've already seen non-U.S. volatility in areas like India, South Africa, France, and we're approaching the U.S. election. Good news is U.S. markets tend to be up in an election year. Bad news is we see a lot more volatility. That's probably what we'll be looking at in the second half. But it's not all doom and gloom. Earnings are looking still pretty strong. Second quarter earnings expected to grow over 10% year over year. And I think if companies led by tech can dominate earnings again, then the market should stabilize.
Okay, you gave us a lot to think about in a short time, so I just want to focus on the consumer because I have also been interested
I'm not any calmer after that.
to see the discounting that we've seen at some of the fast food restaurants, and you're mentioning some softness when it comes to the labor market. How does that then play into tech companies and tech earnings? We just had this conversation with Gina Martin-Adams, our chief equity strategist here at Bloomberg Intelligence, and she talked to us about the disconnect between what the consumer is doing and what happens at tech companies with this economy.
Well, tech companies are all different animals. Let's just start. Everyone talks about the tech sector. Let's look at semiconductors versus software year to date. The gap in performance is something like 45%, with semis dominating and crushing software as a sector. So it's all different. Tech companies that have strong AI tailwinds, of course, are going to continue to do well because AI is here to stay. It's not just hype. Companies need to incorporate that into their business models to drive productivity. Consumer-related tech companies could start to struggle more, but again, it depends. Look at Meta, which is more of a consumer outlook, but they started cutting costs so early in the cycle that you saw their first quarter earnings. They were still strong for at least earnings point of view. And Apple, a very consumer-driven company where so much negativity was getting baked into the stock price, it was lagging, and now we're in a cycle, a seasonal trade for Apple that's been very strong.
I want to ask you about AI a little bit because it's been like the catchword for everyone. I'm getting ready for the next earnings cycle, so we count how many times executives say it. Having said that, AI productivity, we're still figuring that out, right? We're early in the game. If that starts to see a little bit of a pullback, does the market lose a lot of momentum as a result? Because so much seems to be tied to that narrative.
Well, that's a great question because tech and AI has been such a driver of not only earnings but market returns since the beginning of 2023. So what we need to see is for the markets to broaden out if tech starts to pull back. If you look at second quarter earnings, actually, I mentioned they're going to be up a little. Their consensus is up a little over 10%.
Right.
Non-tech earnings are expected to be up almost 8% of that. So it is supposed to be a broader second quarter.
That's pretty
for earnings.
significant.
If that's true, I think the market can broaden out. But I agree, it's not the healthiest market when it's driven by very few companies. It's like a stock with only one catalyst.
Right.
Our catalyst is tech. It's basically NVIDIA. If NVIDIA doesn't work, what happens to the rest of the market? I think that adds some fragility to the markets.
Hey, speaking of stocks, we are still getting earnings, believe it or not. I do want to bring our viewers and listeners some news. Shares of FedEx are higher by 8% right now in after hours. The company did report fourth quarter adjusted EPS that beat analyst estimates. Also said that it sees 2025 adjusted EPS to $20 to $22. The estimate was for $20.85, so some optimism there.
Do you care about it like a transportation company and what it tells you? Do you look at that sector for clues?
I think transports can be very important clues for the sector. I was thinking of FedEx. If you ask my family, the amount of FedExes and UPSs that come to my house is a telling sign that the transportation sector is still very strong. But transportation infrastructure is a sector that we've liked for many years. We think it's a multi-year, multi-decade play for a few reasons here. Number one, nearshoring and onshoring of manufacturing post-COVID. The U.S. wants to bring manufacturing closer to home. Electrification of our grids to meet renewable energy demand. We'll have to increase our grids by over 50% over the next decade plus. All of this is positive for infrastructure. That's a sector which has numerous tailwinds.
You're like setting me up perfectly for more breaking news that we have, Sarah. Volkswagen plans to make a $5 billion investment into Rivian. Rivian and Volkswagen plan a joint venture for next-gen EVs. I'm looking up shares of
How
Rivian
long
right
can
now
companies
in the
keep
after
spending?
hours.
Like, they have been given a boost. There's a lot of liquidity out there, whether there's government, infrastructure spending and different kinds of plans. But it does feel like, I don't know, what are we missing? What is the big risk? Is it the elections? Is it that with this, nearshoring, onshoring, that everything is actually going to be more expensive going forward because labor is more expensive, right? Like a chip made here versus a chip maybe made over in Taiwan is probably going to be more expensive. I don't know. Like, what is the big risk that worries you the most?
Well, for a market that wants its rate cuts, we've already seen inflation reaccelerate earlier this year. So it moderated at the end of last year. It starts reaccelerating this year. Now we're seeing it moderate again. If we see a few more months of that, we could get to your first rate cut. But what if interest rates are here to stay? What does that mean for the U.S. deficit? What does this mean for companies that are small and highly leveraged and want to go public one day if the IPO markets aren't that healthy? I think it's just so different from where we were from 2010 to 2020 that a lot of investors and younger investors aren't used to that. If you take a look at history, though, pre the global financial crisis, going back about 50 years, interest rates, federal funds rates were on average a little bit below 6%. And post the GFC, they were basically a little bit below 1%. So that it's not a new normal, it's just an old normal. We're going back to that normal cycle that we saw pre the GFC, but I don't know if many of us in our careers or even where we are in our lifespans are used to that.
Well, what does that normal look like, though, in terms of rates?
I think it looks, if you take rates that were sub 1% below post the GFC and almost 6% pre the GFC, I think rates are probably more normally in the 3 to 4%.
That was the
range.
abnormality.
Post the GFC.
Right.
Yeah.
Right?
Exactly.
No. Right. Yeah.
When they were sub 1%, that's the abnormal period rather than the period that we're going back to.
So are we wrong to have the conversation of like, oh my God, what is a higher rate environment going, we talk about, the Fed, the Fed's target, that maybe it needs to run hotter. Mm-hmm. Are there negative implications, or is it, no, wait a minute, that's a little bit more akin to historically how markets operate and we do just fine?
I think we just need to evolve how we think about it. So one thing at Nuveen is we're very strong in publics and private investings. I've talked about how the 60-40 equity fixed income portfolio will evolve to 50-30-20. Equities, fixed income 20%, and equities 50%, fixed income 30%, and alternatives 20%. Why do we like alternatives? Well, one is public and private infrastructure, an area with so many tailwinds, also a hedge for inflation. Farmland, which is a large part of our alternatives portfolio. Farmland has beaten inflation by 8.5% on a 30-year basis. So there's these non-public asset classes that are great inflation hedges, provide income to investors, have all these tailwinds. Just need to think differently about how we invest.
How does that work? How does that work?
Are you getting cash flows on farmland? How does that work?
So farmland, you get two things. You get the price appreciation of the land. Obviously,
but
it's
only
a necessity.
If you sell it.
Over time, right? But same with stocks, right?
Yeah.
You get it if you sell it.
But the value
But
goes up.
there's a finite amount of farmland, whereas stocks,
Right, which also makes it more of an attractive asset class, actually. And then the income from farmland and the crops. So it is sort of stock and bond-like. Income from bonds, stock-like appreciation.
Help me out, though. So investors own the farmland, but then somebody operates and cultivates it and develops it?
Yes.
And is it like big companies, or is it just the big industrial farmers?
I mean, it can be a variety.
Okay. Mm-hmm. Sorry, it's just fascinating.
This is great.
I mean,
and we have the author of this
guest.
book that's out today. It's called Free the Land, How We Can Fight Poverty and Climate Chaos.
I feel like everything I talk about, the company
reports. Were you on our editorial call
reports.
earlier today, Sarah? I mean, this is wild.
Well, they talk about, land as a commodity.
Yeah.
And the commodification
and
of
you and
land.
I were talking about it.
And
It's like the ultimate supply-demand.
Exactly, right. It is the ultimate
constrained.
supply-demand. How does climate change play into that? Because I do think climate change is certainly impacting where we can farm easily.
Well, I think it is definitely can impact your crops, your yields. A lot of our crops are very concentrated in certain regions of the world. Soy is concentrated, corn is concentrated. Those are risks. I think climate, the shift to renewable energy is something that's important to talk about. I mentioned it's a tailwind for infrastructure, but another area I think is important is how, from a commodity point of view, we're not necessarily ready to cross that bridge to renewable energy. What the U.S. has been underinvesting in copper for many years now. I think U.S. copper production is down about 50% in the last quarter century. So are we ready? Copper, cobalt, lithium, all the things that go into electric vehicles, solar, wind, batteries, are we ready for that in terms of our commodities? I don't think that we are.
Does all the money come from the private markets for that, in your view? Where does it all come from, ultimately?
The money to invest and increase our commodity production. I think it can come from a variety of places. I'm more worried also that's inflationary again. If we don't have the supply of commodities to meet our demands to move towards renewable energy, then it's going to be inflationary for copper, cobalt, lithium.
I'm wondering how you're thinking about the role of alternatives in someone's portfolio right now, especially if they're not necessarily a high net worth individual, because you deal with a lot of money of folks who are, quote unquote, normal people who are relying on you for their retirement.
Well, I think the race for alternatives is that last mile, getting it into the hands of the individual investor. We are getting it, it's an institutional play. It is a high net worth play. It's moving that direction. I think the final mile will be getting it into the hands of institutional investors.
Does that happen?
They can. I think it will over time, and for individual investors, and that will provide them that less correlation in their asset classes in their portfolio and more diversification. I started in the industry as an investor about 29 years ago, and back then it was you picked equity, you picked fixed income, you picked real estate as an asset class to work in, and now you look today. I mean, you can just in our firm, farmland, equity, infrastructure. There's just so many interesting asset classes now.
So you've seen a bunch of market cycles. What's interesting about this market cycle today, and is something different this time around?
Well, I was a small cap growth investor in the late 90s. I'm still a global equity portfolio manager, so I've been investing, from about the mid-90s until today.
Right.
People talk about the tech bubble. What's AI? Does it look like the internet bubble that we saw in the late 90s? I think it's different in the sense, first of all, as an investor in the late 90s, when the internet first started to become something that was more widely known, we had so many companies. We all remember iPads and all the different companies that you could invest in that weren't really on a path to profitability. Today, in artificial intelligence, there's basically two huge players, NVIDIA, Microsoft, some other players. Supply is limited of public companies. Given the rate regime we're in, it's not as easy to take a small company, make it profitable, take it public. So I think we have a huge supply-demand imbalance, which is why you've seen these huge runs in these AI companies.
So distortion in the public markets because of that.
Well, huge demand, lack of supply. I don't. If you look at,
but does it lead to some kind of distortion?
Well, if you look at NVIDIA on a valuation basis, it actually trades at a discount to the semiconductor sector average. It's not an expensive stock.
But everybody keeps saying.
If you look at their earnings growth and their earnings power, it's not actually an expensive stock. So I think that's what is the pushback on the bears on NVIDIA.
All right.
But
finish.
I was going to say, but like we learned in the late 90s, consolidation phases will exist when there's a new technology and a shift like we're seeing to AI.
I'm just going to say, this is the podcast to download on your way home. If you missed any of it, came in midway, this is the one to listen to. What a gem.
You.
Thank you so much. Really
Thanks for
appreciate
having
it.
me.
Saira Malik, she's Chief Investment Officer at Nuveen, joining us right here at Bloomberg Invest.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, so there's headlines happening. There's people surrounding. There's a little bit of a break at Bloomberg Invest. And we are here with the individual who has been working her butt off, I can say, over the last few months to put this together. Bloomberg Global Finance Correspondent Sonali Basak is here. She is, of course, co-host, too, with Tim on Bloomberg Crypto, Tuesdays on Bloomberg TV. How are you? How are you doing? And I don't know. What are you taking away from the event so far?
I think you hear the background. You're running off adrenaline a little bit here. It feels like a sports game.
Especially with these headsets on, right?
Yeah, no, seriously. But it does feel like game time here because we're halfway through the year. Obviously, a lot of concerns. I'm sure you've been covering a lot of them.
Yeah.
But there's also a lot of optimism in terms of the way things might shape up. So, for example, we were just talking to Paul Taubman, who's the CEO of PJT Partners, and he's in an industry, investment banking, where things have not rebounded. And, he thinks that after the election cycle into next year, there's more clarity. And so maybe we're not operating on the time horizons here that anyone would like to be, really benefiting from the fruits of their investments. But next year might be a brighter year.
Okay, Paul Taubman, just one of the many folks who you've already interviewed today. Give us a rundown of some of the conversations that you've had.
Yeah, one of the more interesting conversations also was with Cliff Asness. Cliff Asness is the founder of AQR, of course, and remember, he had a couple of tough years there before the COVID pandemic hit. Mm-hmm. He's had a historic rebound, record-breaking returns at his fund, and he thinks the market is less efficient now. That has a lot of ramifications.
Why?
He thinks it's a few reasons. He thinks that the prolonged low interest rates could be a candidate for why this has happened. Meme stocks, putting some pricing out of whack with fundamentals, passive investing, and a lot of debate about how much each of those things is playing a role to the wild price movements, the distortion in prices that we're seeing in the market.
If there's It's so funny. Like, we'll go to some kind of event. You know this. You go to a financial event, and there's like something everyone is talking about. I feel like increasingly it's been a lot of AI. Is there something, in years past it's been crypto. We only get about 30 seconds. Is there something that you feel like?
Private assets.
Private assets.
Everyone had something to say.
Meaning alternatives?
Alternatives.
Or
private
credit?
Private equity, venture capital. How do you get in and how do you not get hurt when you get in?
Interesting.
They don't know yet, right?
They don't know yet.
There are a lot of
There's
people
pain.
who are worried about pain in private equity coming down the pipe.
Well, and I think about, we just don't know. In private credit, I mean, there's so much money chasing it at this point, right? Like, you just don't wonder. And you do wonder, when there's so much money, does it tend to take on riskier investments or so?
Listen, Boaz Weinstein has this huge activist campaign against closed-end funds at BlackRock. And these are in the equity market for the most part, sometimes more illiquid assets. You have to wonder whether you'll start seeing activists in these other funds that are being sold to retail investors for private assets too.
Such good stuff. We know you're busy. Get back to work.
No, have a drink.
I'm ready for a wine.
Okay.
Bloomberg Global Finance Correspondent Sonali Basak live here from Bloomberg Invest.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.